Welcome to a video that I like to call the deep dive video. As I usually say, please don't let this name mislead you. I use this in a bit of a different context. Every week I do daily videos, I do a weekly video, I do an intermarket analysis video. At the end of the week, I go back and I look through all of the daily charts and I pick out those charts that I didn't talk about in any of the videos, or maybe I just showed once or twice, and I put them together in this video because sometimes we're always looking for clues or insight as to what's happening in the market. And sometimes we can get that by looking at some of the charts that don't seem to be waving really big signals at this time. And so that was the idea behind this particular video. Also, there's a few charts that I use and I look at every day, but I don't show in any of the videos. And I also put those in this video as well. This is being prepared for Monday, October 23rd. The first area to look at is a thing called the VIX. Now, this measures fear in the market, and I have to turn on my laser pointer. Gotta love take one videos here. What I do is I put the VIX on this chart, and then I make it invisible, and then on top of that, I put a 50-period exponential moving average. That's the blue line that you see, and we usually use the VIX with a static range of numbers, 12 to the downside. That means that the market's getting not very fearful or very complacent, or 20 to the upside, where it means there's an awful lot of fear. Well, that's nice when we stay in that 12 to 20 range, but look at this blue line. There are times when we spend years above 20 and we form a new range. So this chart just gives us more of a dynamic look at the VIX and how it changes over time. We have been from about 20 to maybe 28 or 29. That's the range that we've been in. However, in 2023, we've been dropping down below this. Now we're turning back up as the market's been running into some difficulties, but we'll have to see. Are we going to go back up above 20, or are we going to stay down here and start to generate a new range? It's always good to know where we stand by looking at a bigger picture of the VIX. Then another way to look at the VIX, and I only show this chart when it's actually telling us something, because sometimes the VIX doesn't give off a lot of clues by itself. So I have a number of different charts that I look at to measure fear and greed. This is a VIX to S&P 500 correlation. And up on the top is a 5-period simple moving average of the VIX. And we follow that on other charts quite closely. In the middle is the correlation. And when we start to really spike up in this correlation, the market is getting nervous or something is expected to happen, even if the VIX is not necessarily giving us that same kind of a signal. Right now, we've been pretty low for the last, couple of months. So we really haven't been using this chart. We're starting to go back up now, but we're not up to this dashed line yet. That's when we really pay attention to this chart. Since we're below this level right now, I haven't been talking about this chart. Then we look at how fast is the VIX moving, and we use an RSI measurement based on 9 periods to see if we're going up or down quickly. We had a down day on Friday, and we actually closed above 20. We haven't seen 20 for quite some time in 2023. So the VIX has really been going up pretty far, pretty fast, but we're not quite into that extreme reading yet. If we have another down day on Monday and the VIX really goes up, we'll probably go up into this extreme area, and then I'll be starting to show that in the daily videos. We also look at a little different measure of trying to look at fear and greed by a thing called the skew index, where the VIX looks at the money options and the hedging that takes place on using those options. Well, the skew index also looks at the S&P 500, but it measures the out of the money options, either above or below current prices. And when we get up into this red area, that means the market is expecting some kind of a big move. Now, you could just say, all right, we're going to go down, we're going to go up. And some people like to put this in a box. But if you go back and look at other times when we spiked up and started to come down, sometimes that marked the top, sometimes that marked the bottom, sometimes that just marked a continuation. So we can't really use this chart to make decisions in and of themselves. We use it in the context with some other charts. We're not up in this red area on top or down in this blue area on the bottom, so that's why I haven't been showing this chart. Then we look at the MOVE index, which measures the volatility of bonds, and as bonds have been under pressure lately, that means prices are going down and interest rates are going up. We've seen the volatility increase. Then in the middle portion, we look at the VIX, which measures the volatility of stocks. We had a down day and a down week, so we're seeing the VIX starting to go back up. And then we measure the spread between the two. That's the green line here, just to show how far apart. Are they having a tendency to go sideways like they are now? Are they going up? They're going down? What I pay attention to the most is on the bottom, is the correlation between the two. And that just means right now that they're having a fairly strong tendency to go in the same direction at the same time. So if the move index is going up, that probably means the VIX is going up, and the other way around with that also works. Then we look at the equity put call ratio. This is the last chart to update every evening before I get ready to do the video. Because this updates so late, a lot of times I can't include this in the video, even though it's many hours after the market has closed. This is just a one-day measurement of the equity put call ratio. When this is going up, that means that folks are buying more puts than calls, which tends to be used as hedging or to protect their positions. When the market's really going up, people don't buy puts because that can bite into their overall returns. If anything, they buy more calls, and we see this ratio going down. The one-day chart doesn't help us all that much, but when we look at it over a period of time and we have different studies that we place on here, then it can become more useful. Then this is a longer-term look at the 5-period simple moving average of the equity put call ratio. Lately, I've been showing a shorter-term version of this same chart because we've been going down and then going back up and going down. This goes the opposite way of stocks. So if the equity put call ratio is going up, that means stocks are going down and vice versa. Well, we've been chopping around above this 0.8 level, which is usually an extreme reading. Well, we fall back down a little bit and then we go back up and then we fall back down. And now we're starting to go back up again. You can't really see that in this chart. I've been using another chart instead, and that's why you haven't been seeing this in the videos. We also have another fear gauge. This one's going back up just a little bit, but this chart is skewed a little bit because we have the huge bump up that we saw during the COVID plunge. I could change the time frame on here, but I want to include just how much this measured as stocks were really going down. So I don't show this one all that often because it just looks like a little blip down here in the corner. Fear has been increasing overall with pretty much all of our charts. Then we want to know, how far are we from the all-time high, which was set in early 2022? We're down 12.34% from that all-time high. Way over here on the right, that's where we closed on Friday. Way over on the left, that is the all-time intraday high that we hit. Then I look at a regular version of the NYSE advanced decline line. There's a number of different ways that this is measured, so I have multiple charts that show this. When I was showing this chart the most is when we were going up and looking more positive. You have the S&P on top, and we would come down and we started to form a trend here, and we broke down a little bit below it. Some problems. Well, we came back up. And now we've totally fallen below this trend line. In fact, we're in danger of actually having a death cross with the advanced decline line itself. That's turning things a bit more negative. But since we fell below this trend line, it really hasn't been as useful to show. Then we look at the common stock on the NYSE. We have an advanced decline line based on price. That's on top where it's declining now. And then we have another advanced decline line based on volume, which is also declining. What we're looking for is previous lows that we've hit. We're looking for divergences or convergences here. We haven't really been seeing all that much. We're keeping an eye on some of these other levels to see, are we going to find some support either based on price or volume at some point, and then turn around and go in the other direction. We look at discretionary, which is more growth oriented, and then we use that with an equal weight ETF where everything in that ETF is treated the same. It's not weighted like a lot of other ETFs. Sorry, I had to cough. You got to love Take One videos. Well, when you look at discretionary just by itself, it's starting to show some weakness. And this has been one of the stronger areas in 2023. The fact that we're seeing a death cross here, that's a bit of a concern. We also have another equal weight ETF that shows the staples, and that has really been in a decline, and that's not really a surprise, but we're seeing discretionary. It had been outperforming staples. So then we take a ratio down below where we show that discretionary is outperforming, even though it's coming down with some weakness. It's still on a longer term uptrend, but if the market's going to turn around and get more positive, we want to see discretionary turn and begin to go back up as well. And we're not seeing that right now. Some technical alerts. These are for the whole week that we just finished. These are put out by stockcharts.com. You can go there and look at them. When they're green or blue, they're positive. When they're red, they're negative. and they look at other indexes, they look at sectors, different markets, and when something of a technical analysis nature happens, it gets posted onto this, and you read it from the bottom up. We started in Monday's session at the bottom. We went all the way to the top. That's Friday's session. And we had a pretty big down day. So you see lots of red here. We had a pretty down day on Thursday. So you see lots of red here as well. Earlier in the week, we had an up day. So you see lots of blue or green. I don't know how much this color is showing either way. So I say blue or green for this chart. Then we have 5 different indexes that we follow. There are lots of indexes, and then there are indexes inside the stock market that we follow. But the main ones are the S&P 500, and that's the focal point and the center of everything that I do and everything I analyze. But we also look at the Dow. We also look at the NASDAQ 100, and then the mid caps and the small caps. So there are 5 indexes, and stockcharts.com has this mechanism for in an unemotional way of rating them according to their charts right now. The better or the higher the score, the better their chart is looking on a score from 0 to 100. And what's still coming in first place are the QQQs. Now, there's a positive side to this and a negative side to this that I point out. The market's been under a lot of pressure lately, but we haven't really been seeing the score going down all that much. So it's not really taking in the weakness. That some of that has to do with the fact that earlier in the year, the QQQs were really strong. And even though they're falling back right now, that strength is still being measured in an unemotional technical analysis chart. On the other hand, you can say, even though we have been falling, their charts are still holding up with a score of 93.7. Generally 90 and above, that means they're more positive. Then in second place, we have the SPY, which is the ETF for the S&P 500. It has been declining a bit lately, but it still comes in second place with a score of 73.6. Then in third place are the diamonds, which is the ETF for the Dow. It has been declining as stocks have been under pressure. It comes in at 61.2. Then the mid caps, which were stronger earlier in the year, now they're really starting to see some weakness. They're coming in at 34.7. And then we have in last place or fifth place are the small caps. And this is represented by the IWM, which is the ETF for the Russell 2000 small cap index. They're really seeing a lot of weakness right now, coming in at 17.8. Some short-term charts. This is a short-term rainbow. I show this off and on. This goes from 10 periods up to 50 periods in the simple moving averages, and I make them different colors so it looks kind of cool. And this just shows that in the short term, we're more negative. We're down below all of the moving averages, and the whole ribbon itself is starting to head lower. Then we have the CMB composite, and I use this more like an oscillator where we get an extreme positive reading, which we saw not too long ago. Well, the fact that we're declining and below both of these lines, we're negative. When I'll pay more attention to this indicator is if we actually drop down below the black line. I put these black lines on here myself. I just kind of eyeball extreme positive or negative readings and then put a line on here. So there's nothing magical about these lines. They just are used more as a reference point. Then we have the Stochk RSI, which had been extreme positive just a couple of days ago. It's turning more negative. We have its counterpart, the Williams percent R. That's being used in the daily video right now. If we have another down day, this Stochk RSI, which tries to take stochastics and RSI and put them together, and it's a pretty touchy indicator, it'll probably come down to this extreme negative reading, and I'll be using it in the daily video. Then we have the 20-period average, both simple and exponential moving average study. We were bouncing around between the simple and exponential average for a while, but when we started to develop more weakness, we're dropping below them, so I haven't been including them in the video. Some intermediate term charts. Here's a longer term rainbow going from 50 periods up to 100 periods. We're starting to roll over with all of the rainbow lines here, and we're dropping down below it with price. So this is turning more negative intermediate term. Then we have the Arun indicator, and it's been pretty much flat. Sometimes I show this every day. Then I go periods of time and I don't show it. This is kind of a crazy indicator where what it tries to do is the red line are sellers, and it shows that they are decreasing. The green line are buyers, and they are also decreasing. Then the difference between the two gets measured as this oscillator. We're below zero, so that means it's negative, even though we're turning up just a little bit. This can go kind of crazy at times and actually go against logic that we're seeing on other charts. I still think it's useful. I still like to look at it, but I don't make a lot of decisions based on it. Then we have a 50-period moving average study. We were using this. This was the exponential moving average study that we were bumping into as far as resistance. Now we've been breaking down below that, and so I haven't been showing this chart for the last few days. We have a 100-period moving average. For a while, we were right in between the simple and exponential moving average. Now we've broken below that. Standard deviation. What is the stock like right now versus where it was 10 periods ago? Is it moving a whole bunch, or is it not moving very much? It shows that we're seeing a bit of a pickup and move because we're coming up and it's going above the moving average. This does not measure direction. This is trying to measure velocity or speed of an actual either index or stock that you use. I also have a standard deviations chart, which I use in a completely different context. This is the Sean trend meter. We're still in this kind of yellow sickly looking area. This is more neutral. Since we're going down, it is more negative than positive. If we come down into this pink area, that will be extreme negative. Other times when we get up into these different green areas, that means we're going up a little too far, too fast. We also look at Bollinger Bands, and we're right down at the Bollinger Band, but we're still above it slightly. So we're not getting an extreme reading here. We often use this to look at, are we above or below the midpoint, and what is the midpoint actually doing? It's going down, and that's more negative for the market. We look at the Ichimoku cloud, which are really just some moving averages based on current prices and then shifted forward. Sometimes these can be used as support or resistance. For quite a while through the month of August, we were inside this green cloud and we couldn't really break out of it. Then we ended up breaking down below it. Now we're coming up into a red cloud, but prices continuing to go down. If we turn around and start to go back up, will this area end up providing overhead resistance? Then we want to keep an eye on the S&P 100, which is in the bottom. Those are the biggest stocks that make up the S&P 500, which is the chart on top. We're looking for convergences or divergences here, and they're pretty much converging with each other right now. They're both going down and not really out of step with each other. We also keep an eye on a point and figure chart. Even though we were down on the week, we were in this area not so long ago. Point and figure charts just measure price movement. It doesn't take time into account. So we saw nothing new drawn on the chart this week. An X is drawn if we're going up, an O is drawn if we're going down. And since we were here before, the last signal that we had was generated on September 26th, which was a double bottom breakdown. If we see more zeros drawn in here, that will turn things more negative. Then some long-term charts. We have an anchored moving average going back to the all-time high. And even though we've been declining, we're coming down and retesting this previous low, we're still above this red line. If we continue to fall, then I'll be showing this chart quite a bit. We have a long-term rainbow going from 50 periods up to 250 periods. And it's not rolling over as much because it's slower, but we're down inside about the middle part of the rainbow. Then we keep an eye on the S&P 500 on a weekly chart that's on top. The German DAX, that's the biggest stock market in the EU. We look at a weekly chart there, and we just want to know the correlation between the two. Right now, it's getting a little bit stronger, but the correlation isn't all that strong with the DAX and S&P right now. We look at some different support and resistance, and I've been using a lot of these charts in the videos that I'm not going to show here. This is a chart that I drew a number of months ago where I started with the June 2022 low, and then we made the October 2022 low, which was almost a year ago, and I drew a trend line between them. And then I went to the all-time high, and I drew a parallel line. That's the red line here. Earlier in the spring, when we were starting to go higher, this was acting as resistance, and then we broke above it. So I stopped showing the chart. I'm going to extend this red line down, or just keep an eye on it. And if we continue to fall, we'll see if this ends up acting as support. But that would take a pretty nasty fall from where we're at right now. Some broad market indications that we look at. This is the VIXN, which is the VIX for the NASDAQ 100. You can see we have these icicle-looking things with the bar chart. If I look at anything, it's usually the line chart here, and it just shows how as the NASDAQ 100 has been going down, fear has been going up. Then we want to keep an eye on the transports. When the red line is underneath the black line, that means the transports are underperforming. They're both going down right now, but the transports are tending to go down even faster. And then here's a longer term look on with a weekly chart of the QQQs, which measures the NASDAQ 100. We also have an anchored moving average going back to the all-time high. Even though we've been declining and we're seeing if any of these other areas are going to provide support, if we continue to fall down to this area, then I'll be showing this chart again. Banks have been under a lot of pressure going back to March when we first had the crisis come out, and the market's just kind of sitting and waiting. Is there more on the way? Well, in the meantime, the bank ETF really went down. It's pretty much been going sideways, and it continues to be in a downtrend. Then we look at the regional banking ETF. Those were the ones that got hit harder, and they're even underperforming the financial sector, and they're still in a pretty significant downtrend. We want to keep an eye on the ratio between the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow. They're having a pretty strong tendency to go in the same direction, and right now that direction is down for both indexes. Some rate of change charts just to look very long-term. This looks at right now and then goes back 250 periods ago. We're starting to see a decline here on this chart. Here's a longer-term look at that same chart. It's a little more muddled, a little harder to see here. This just gives us a really long-term look at the overall trend. Keeping an eye on some bonds, where we have the red index up here. That's the S&P, and it's been going down. We have the long-term bond ETF. That's in blue, and that's been going down as well. So their longer-term relationship is pretty strong when we do a correlation based on 50 periods. Their shorter-term relationship based on 10 periods, it's kind of strong, but it's not as strong as the longer-term relationship, and you can clearly see that they both have been under a lot of pressure lately. Then we compare bonds with stocks. When this is going down, that means the bonds are underperforming, and both have been under a lot of pressure, but bonds have been bouncing up just a little bit lately. However, they're underperforming as far as a trend when compared to stocks. Then we look at value to growth, and we take a ratio of that, and that's the black line, and it's been declining. And then we look at the 10-year yield, which is going up and up and up and up and up. This is having a slight tendency to go in opposite directions, which you can kind of see by the chart. This is going up while this has been going down, so that kind of makes sense. Then we look at the QQQs, the NASDAQ 100 to the long-term bond ETF, and they both have been under a lot of pressure lately, so they're having a fairly strong tendency to go in the same direction. Then we look at the equal weight ETF of the S&P 500. That's in blue, and that's been going down. And then we take the MOVE index and invert it, and that's also been declining, but it's just a little bit above the neutral area right now as far as our correlation. This is a newer chart. I'm really trying to figure this one out. I'm not sure we're getting any real good insight from it. Then we're also looking at the 3-month yield, because back in 2007, we topped out, and then right after that was the great financial crisis. We came and we're actually setting a new high now, and we're wondering if this rolls over and starts to come down, is that giving us a warning sign that we're heading into another financial crisis? We're also seeing a real change in the interest rate environment, where for the last 40 years, we've had lower interest rates. Is the reason why this is going up just the fact that interest rates are shifting to a higher environment now, and maybe this won't even end up giving us any kind of a signal? We still want to keep an eye on this just in case it does start to flash something. Then here are the different yield curves, the 10 to the 2 and the 10 to the 3 month. I actually have charts of these. They're still inverted, but they're showing some improvement. When they cross back above it, that's usually when the time clock starts to see if we're going to head into a recession. The other two yield curves that we follow, the 30 to the 5-year and the 10 to the 5-year, they've actually gone back above zero and are no longer inverted. Here's a look at the 10 to the 2-year yield curve. And some people just swear by this. This is what you need to look at. Yes, yes, yes. And after getting very, very inverted, it is starting to come back up. And if we see things continue the way they have been, this may actually cross back over and go back to being normal. Then you have other folks that say, no, this is the one you really need to pay attention to, the 10 to the 3 month. So that's why I watch both of them. It is starting to come back up, even though it's still inverted. If we continue to go up, then we might go back to being normal. Then some possible positive scenarios, and I've been using a lot of the charts in the daily videos. This is the stocks inside the S&P 500 that make up the S&P. Where are they in relation to their 200-day simple moving average? And this is starting to, actually it's continuing to show some weakness. Sometimes we use this like an oscillator when we get extreme positive or negative. We haven't had one of those in a while. This is just suggesting that things are more negative as this goes down. Then we look at the 2-year treasury yield, which continues to go up, because sometimes when it spikes up and starts to come back down, sometimes that will give short to intermediate term support to stocks. But as long as it continues to go up, it hasn't been doing anything. And then we look at the mid caps and then look at the stocks above their 50-day exponential moving average. And this has been declining. This is showing some weakness, but we're not at an extreme negative reading yet. We also look at the small caps, also showing some weakness, but not at an extreme reading. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post to get the proper context of what I'm talking about. This is not meant to be a standalone video, so you're really only going to get more help with my analysis if you also look at the other videos. I hope you have a great weekend, and I will talk to you in the next video.